Hey everybody, today's Thursday, January 19th. Sina here, and today we're going to talk about FOMC meeting that happened yesterday, Wednesday. So the Federal Reserve decided to keep the rates steady, and in this video, I'm going to explain what that means, why they made that decision, and when is it likely that they'll begin cutting rates. So the most important headline from the event was that they kept the rates steady. And what basically they say is that they see the risks to unemployment and inflation as roughly being equal. So I have 10 points to summarize what happened. Point one, they kept the interest rate steady at 4.25% to 4.50. And this is going to be the fourth straight meeting where they didn't change the rate. They have been on a long pause, especially after Trump's tariff debut. Second point, they say that the economic uncertainty has diminished. However, they qualify that by saying it remains elevated, so they discount it for now. They're happy that they got better clarity on the path for tariffs, but they're not happy with where they are right now. Number three, 2025 GDP forecast was cut to 1.4, signaling cooling economy. So they are predicting economic slowdown. And if you've been following our analysis and Bitcoin intelligence, you know that for a long time we've been advocating this idea that tariffs would actually cause a recession-like scenario, meaning economic slowdown, without actually getting the recession. So we are definitely headed in that direction. But then number four, the Fed thinks inflation is going to be higher. So they raised the projection for 2025 to 3.0%, up from earlier estimates. So they think tariffs will cause inflation to go up. And this is where I really differ because as you get economic slowdown, any potential price hikes because of tariffs would be quickly met with consumers pulling back and not spending. And if they have to overspend on a product because tariffs raise the price for them, they'll underspend on something else. That being said, you also have to consider that all these tariffs are on goods, and inflation is much more impacted by services. And if the economy is slowing down, service spending and service activity slows down, probably more than you will see prices of goods are rising. So overall, the economic slowdown would overpower the inflationary effect of tariffs. And again, that has also been a central part of our thesis in 21st Capital and Bitcoin Intelligence, that we should initially see a spike in prices, but it quickly will give way to economic slowdown and prices going back down. And we certainly see that when you look at the data. So if you look at our last report, we clarify what's happening with inflation. For example, in Monday's report, we look at PCE inflation, and this chart summarizes pretty much everything you need to know. First of all, the orange line is showing monthly inflation, but we've turned it into an annualized metric, so it's comparable. So the annualized PCE is 1.21. So basically, if the readings continue like this, by the end of the 12-month period, you will only have 1.2% inflation, way below the 2% that they're looking for. But 1 month is not enough. So what if we look at the 3 months? So this blue dashed line is giving us that. So the last 3 months, but then annualized, that will be 2.13. So we have one low rating, a second low rating, and a high rating. Combine the three, you get 2.13%, which is only 13 basis points above the Fed's 2% target. So definitely the trend looks to be very promising for the Fed. You can also look at the year-over-year number, which is our white dashed line, and that also shows a clear downtrend, which got to a minimum, had a little bit of spike, again, probably due to tariffs, and then it's going back down. In the next few months, we should definitely see this drop below 2. And if the Fed really wanted to be forward-looking, they would see this and take this signal as a sign that inflation is on its way down. And so they could begin to slowly and step by step reduce the rates, but they're not. They're choosing to be too cautious at this point. It could have also a political angle. Trump has been pressuring Powell to cut the rate, so they may want to show independence by looking at one part of the data that gives them better cover for not dropping the rates. But they could have looked at the same data and say we're all on track. We don't want to be too restrictive when inflation is already coming down. And so we begin cutting the rates in anticipation that the next few months inflation will be controlled. But they choose to be data-driven when they want, backward-driven when they want, and forward-looking when they want. You can also look at CPI inflation, the month-over-month number, the orange line printed at 97 basis points, so not even 1% inflation. Previously, we had a month of slightly above 2, and then before that, we actually had a deflation month. But you can also look at the last 3 months annualized. That's about 1%. So we've had 3 months of inflation data showing that CPI is only rising by 1% annualized. So that's, again, another great sign they could have looked at. And if they really wanted to cut the rate, they would have coded this one and said, everything is going great, and we don't really want to be too tight with monetary policy when everything is going great. However, the year-over-year number for CPI is 2.4. And again, that also is predictably going down, especially because everyone, and including the Fed, are now expecting economic slowdown, which will definitely bring these numbers further down. You could also look at PPI. That shows the same idea, producer price numbers. That shows deflation in the last 3 months. If you combine the last 3 readings, the inflation number is negative. Year over year is already very low, below 2% at 1.46. So they could have said that we are happy with where we are with inflation. Okay, so that's the inflation. Number 5, they then talk about unemployment. They mentioned that unemployment rate now is expected to reach 4.5 by year end. And if you look at the numbers right now, it did hit a minimum of 3.4, down from a high of 14.8% after COVID. So we are predictably and very steadily increasing on unemployment. We've had some stability in the last few months, coinciding with them cutting the rates. This has slowed down the upward move, but they are now predicting that it's probably going up to 4.5%. Now, again, you have rising unemployment in your forecasts, and you have very clear decline in inflation. So they have 2 good data points, and instead they're looking at a hypothetical data point. Number 6, we also got the dot plot in this meeting, which was very helpful in determining where their head's at. The median forecast was 2 rate cuts in 2025. So this year we are expecting 2 rate cuts, and this is actually exactly what the market is predicting. So if you go to the Fed Watch tool by the CME, by the end of the year, December 2025, we are expected to be down. The highest probability is given to 375 to 400 basis points, which is 2 cuts below where we are. The next point is about the division. And the Fed, 7 of the 19 Fed officials foresee no rate cuts this year. Some people are predicting several cuts, and some people are predicting no cuts. There's a growing internal division going in the Fed. Number 8, interest rate futures are now assigning a very high probability of a rate cut in September. So they're thinking, well, nothing in July, pretty much 92% probability of no rate cuts in the next meeting in July, but a very high probability, about 60% of a cut in September. And then a pause in October, followed by a reduction in December. Number 9, it was also very notable that Powell had a very cautious tone. He is kind of trying to say nothing by a lot of words, and he's saying, there's lots of uncertainty on tariffs, lots of uncertainty on GDP, and labor is softening, but not a lot. to cause worry. Inflation is going down. It's great, but we think tariffs might totally change the game. And I think the caution is something that always exists. They could always bring that up to justify a pause. There are many pro-rate cut data points on the table, but the Fed is choosing to focus on all the uncertainty that's always exists. And number 10, it was important to also consider, as we discussed earlier, that the Fed seems to be, with everything I've said so far, seems to be defying Trump. This is happening in the backdrop of Trump trying to push them into a 100 basis point rate cut, double what they want to do. And Powell is basically trying to leave a legacy of the guy who broke the back of inflation in the time he has, and also wants to defy Trump to leave an impression that he's fully independent and just doing his job for the good of the American people. So they say their decisions are fully determined by economic data, but this is always an incomplete statement. So there is all kinds of data at all the time, and you can choose to look at what you want. So the idea that I'm only guided by economic data is a little bit problematic. So let's see, it looks like unless there is a surprise of an economic slowdown or rapid decline in inflation, they are trying to resist rate cuts as much as possible. But at the same time, you also have Trump that's looking for a replacement for the Fed chair. And it is possible that they'll appoint a shadow Fed chair that would just use rhetoric to calm down the markets and guide for a lot of rate cuts in the future. So the market could begin pricing that in early on. Very interesting times are ahead, and we'll be watching this to see where things go. And remember that we publish Bitcoin Intelligence Report every Monday, where we analyze the macroeconomic trends and monetary policy and monetary plumbing, as well as on-chain data for understanding internal dynamics of Bitcoin. If you want to get our reports, you can sign up on our website at 21stcapital.com/BI to access these reports, as well as our premium videos and analyses that are published on the platform. Thank you for your attention, and I'll see you in the next video.